We'll go ahead and call the November meeting of the Public Pension Oversight Board to order. Good to see everybody here today. I appreciate your participation. At this time, can we call the roll, please?
Senator McDaniel.
Here.
Senator Mills.
Here.
Senator Neal. Senator Nemus.
Present.
Senator Parrott.
Here.
Senator Thayer.
Here.
Senator Wilson.
Here.
Representative Duplessis. Representative Fleming.
Present.
Representative Graham.
Here.
Representative Petrie.
Here.
Representative Pratt.
Here.
Representative Weber. Representative Wheatley. Mike Harmon.
Here, Sarah Beth Gregory as proxy.
Thank you. John Hicks. Victor Maddox. Sharon Mattingly. Representative Miller.
Present.
Senator Higdon.
Here.
Representative Tipton.
Here. And for the record, I do have a signed proxy from Auditor Harmon for his Chief of Staff, Sarah Beth Gregory, to serve on his behalf for today. Yes, sir.
Mr. Chairman, since you brought the topic up of Auditor Harmon's proxy, this will be the last time that his Chief of Staff, Sarah Beth Gregory, will be representing him on this committee because she was elected to the Circuit Court earlier this month.
Okay.
And I'd like to note that she is, outside of Judge David Williams, the only and youngest person to serve in the State House, the State Senate, and on the bench. A pretty impressive trifecta and a great accomplishment. So congratulations to soon-to-be Judge Gregory.
Absolutely. Judge-elect Gregory, I'll have to make sure and get a list of counties to stay out of so I stay out of trouble. Okay, enough of that. We do have a quorum. You should have the minutes in your packet. Are any questions? Do I hear a motion to approve the minutes from last month? Have a motion. Is there a second? Second. Have a second. Senator Parrott, any discussion? If not, all those in favor, please say aye. Any opposed, no. The motion carries. Today, in November, we're going to be hearing from all three systems, and I see Bo wanted to make sure I didn't go in reverse order, so he got to the table early. So we're going to get an actuarial evaluation update from all three systems today, and first we have Bo Craycraft from the Judicial Forum Retirement Systems. Please identify yourself for the record, and please proceed.
Good afternoon. My name is Bo Craycraft, and I am the Executive Director of the Judicial Forum Retirement System. It's good to be here this afternoon, and I do appreciate your time and the opportunity to present. I was asked this morning, as Representative Tipton just said, to provide a short actuarial update, and so I've prepared a few slides and also have a few comments. Just wanted to open up, though, and begin my comments by pointing out a little something unique about our results. And just to kind of set the table, so to speak, our presentation and the data that you're going to see is quite a bit different from what the other two plans are going to present. And it's calculated in a different method, and it's used for a different purpose. And so it makes comparison a little difficult. And so I just wanted to set that to start. This relates back to 2013 when GASB, the Government Accounting Standards Board, created some new requirements with regards to the actuarial evaluation. And in doing so, beginning with the fiscal year that ended in 2014, we now have this situation where we get two funding valuation results. We get a funding number that is used for the purpose of employer contributions and determines what we affectionately call ARC or ADEC. But then there's this other separate number that is calculated for GASB purposes, which is used primarily for accounting and annual financial reports. And so for our larger plans like TRS and KPPA, they do what I call a full actuarial evaluation that produces both of those numbers. But in the case of our smaller plan, we do a full actuarial evaluation that includes funding data every other year in line with the budget process. So our most recent funding valuation was done as of July 1, 2021. That valuation was the basis for the budget request that was submitted during the most recent regular session of the General Assembly. And so I say all that just to say that up front, our numbers this morning are for GASB purposes only. So they don't have any impact on the employer contribution or any budget impact. We will do that in 2023. Slide 2 just summarizes that, exactly what I said. One of the things you'll note about the GASB valuation process is we also do what is called a roll forward in these odd number years. So they take the data and the assumptions from our funding valuation, they roll that forward 1 year based on the projections, and then that gets us kind of a revised liability. And then for GASB purposes, the primary difference is that the liability is then compared to actual market value of the plan versus on a funding valuation, we're using a smoothed approach where gains from any 1 year are recognized over a period of time, generally 5 years, and in our state, all of the plans they smooth over 5 years. So the result is that you can get a little bit, you can get different numbers. Historically, for our plan, our GASB numbers have been higher than our funding numbers, mostly due to the fact that we've been able, the markets have been going up until this most recent fiscal year. So our market value on an actual basis was higher than the smooth value. That may not be the case depending on what the future brings, but historically that has been the case. So I go through all that up front just to say, as we look at slide 3 and we look at the funding ratios, again, these are GASB related. All of our funding, all 4 of the plans, both on the pension and health, retiree health side, from a GASB purpose remain funded, but the ratios did decline. As expected, given the roll forward methodology, there was a slight change in the liability. However, on the market value side, on average, the assets of the plans declined 12% in the most recent fiscal year. And so as a result, the funding ratio came down as well. Just to give you an example, the judicial pension was from a GASB perspective, was at 118, and it dropped to 103. So that just shows you kind of the trend. Again, just to make sure we're clear, that's GASB related. And then, as far as the funding valuation is concerned, as I said, we will do a full funding valuation as of the close of this fiscal year, as of July 1, 2023. There's going to be some interesting developments there. We don't know what this current fiscal year is going to look like. My expectation is you're going to hear today that fiscal year 22 didn't completely offset what we experienced in 2021, but it partially did. And so 2020, our current fiscal year could be kind of a swing year, so to speak, on whether or not it kind of overwhelms that nice fiscal year 2021 return. The other thing that's specific to our plan is, all you all are fully aware that we're in an election year, but on my judicial side, all but 3 of my members were up for re-election. And I have a large slew of judges who were at normal retirement, both on eligibility or age. And so we have a tremendous, as of we're about 15% of our active membership is retiring, which is significant for our plan. So I'm interested to see, if it has any impact. Of course, we have assumptions, and as folks get closer to normal retirement, the expectation is they will retire. But for our plan, it's going to be a fairly significant moment. We're going to add a lot to the retiree payroll relative to where we're at today. So those 2 things will probably have an impact, and we'll probably be talking about those things this time next year. Well, with that, if anyone has any questions, I'd be glad to try to answer those.
Well, Bo, thank you for that concise report. I do have a question, and you're probably going to tell me you don't know. But given the factors, we don't know for sure about what the returns are going to be, how the impact of all the retirements are going to be. Do you foresee that the funds will still remain at 100% when we're looking at our valuations for 2023?
Well, for fiscal year 2021, our judicial form, the judicial retirement plan wasn't quite fully funded. It was around 95%.
Okay.
Projected, based on 2021, it was set to reach 100%, mostly due to the fact that we're still going to recognize, 80% of a very strong 2021. My guess is if we were doing it today, we were up almost 40% in fiscal year 21, down about 10 in 2022. So it wouldn't have totally offset that gain. I would have expected some improvement, but if we have another down year, and when I say down, I mean anything below 6.5, right? If we earn 0, it's like we lost 6.5%. So I think we're based on the current year. It might be a bit of a lift to reach 6.5%, and so depending on where those fiscal year returns end up, you might see us, kind of tread water, so to speak, actuarially. So that's why I think this year kind of is going to have a big impact.
How many years has it been since the General Assembly fully funded the legislature's plan?
2018 or 19, I believe.
Okay.
There was a couple of years where they funded administrative expenses, and I think the last budget was the first full budget where there was no contributions at all.
Okay. Do you have everything to the actuary for the upcoming actuary audit, or are they waiting on anything from you yet?
I think we have fulfilled all of their requests. We had a couple items kind of outstanding, but I'm pretty sure I know they were more waiting on me than they were our actuary.
Okay. Any other members have any questions for Bo? Co-Chair Higdon.
Thank you. Thank you, Bo. Thank you, Mr. Chairman. A lot of talk about ESG and proxy voting. I'm sure you've discussed that and are dealing with that. Could you kind of give us an update on that?
Yeah, proxy voting to start. We have one external investment manager that is Baird Trust. It used to be Hilliard Lyons. They handle proxy voting for us. They have a proxy voting policy, and they utilize a third party called Glass Lewis. They are not ESG oriented in the sense that they do not screen investments based on ESG requirements. They are long term. Their investment strategy is to be long-term business owners. And so when they speak about ESG, they say, there are several factors that they share in common, right? They want to hold long-term businesses. And if you want to be in business a long time, then you got to be a good corporate citizen, to your employees and to the communities that you operate in. But that is not a screen that they perform in the identification of, ideas or attractive companies.
Okay, seeing no more additional questions, Bo, thank you for your presentation. The next item on our agenda is a presentation from the Kentucky Public Pensions Authority. So, Dave, if your crew will come forward, and I understand that we have some folks in person today, so have everybody please introduce yourself for the record, and please proceed.
I'm David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority.
Danny White, actuary with Gabriel Smith, independent actuaries for KPPA.
Janie Shaw, also one of the actuaries.
Okay, please make sure that your lights are on green on your microphone.
Yeah, you want.
And pull closer to you. Thank you.
Yeah, GRS reminded me today that the last time they were here in person was December of 2019. It's amazing. And they've been after me for the last year to be able to get here because there's something that's lost when you're not on the screen, as you know. And
Well, we're glad to have you here today. And
they are a valuable asset to us. And we just renewed their agreement, as we announced sometime back. I had just a couple of comments on that. Really, it's a GRS presentation, but they're going to have good news. We had, in spite of the poor investment markets in 2022, those declines were muted by the smoothing effect. So we had a bad market in 20 and a really good market in 21 and a bad market in 22, and the smoothing really works. So it had a negative impact, but not it was muted quite a bit. All 10 plans, all 5 insurance and all 5 retirement plans, pension plans, the funding status increased for every one of them in spite of the market. Thank you for particularly the state police and the $215 million that got into this valuation. You'll see the effect of it. It's pretty dramatic. The additional 2 contributions of appropriations of $240 million won't take effect until the next valuation. And you're going to see a dramatic increase in the funded status and the financial health of the insurance plans. We don't spend much time talking about insurance, but they're getting to be big. GRS will give you a little more background, but it's rare, relatively rare, that a state pre-fund. It's mostly pay-as-you-go. We don't have any recent data on funded status, but if you look at some data back from 2018, we're right at the top. So we are like one of the best, if not the best, funded retirement or insurance systems in the country. So with that.
Thank you. The results of this evaluations are performed every year. This one's performed June 30, 2022. All information is as of that date. For the CRS plans, which we'll highlight some information on, the CRS board this December will adopt the valuations. That'll make those contribution rates effective for FY 2024. In the case of the KRS plans and the state police plan, that is part of the 2-year budget that was established last year. So think of all valuation results for the K plans to be informational purposes. We're going to show what the change in the calculated contribution requirement is, but the budget's already set for that year. And you'll see that what's actually set in budget is more favorable than those actual results. If we go through on the slide 2 here, overview of legislation, there was health insurance benefit increases for certain members hired after July 1, 23. Senate Bill 259, some additional benefits for state police members in the Tier 3 cash balance plan. That was, it's about a 2% of pay increase across all, total payroll, about 6% of pay increase for those just in the cash balance plan. So unused sick leave in excess of 480 hours, think of 60 days, gets converted to cash balance pay credit each year. And then any unused sick leave balance at retirement gets converted to a cash balance credit. So you're accelerating the pay credits in the cash balance plan. As Dave alluded, I think we would agree that House Bill 1 and House Bill 604 were extremely beneficial for the KRS and SBRS systems. House Bill 1, 604 combined provided additional funding up and above the ARC, additional $240 million. So that's going to go in each of the next 2 years. So it's going to go in FY this year and FY 24 next year. House Bill 1 also provided $215 million in appropriations that were paid in the last quarter of FY 2022. So when you see the funded ratio go from 30% to 50% for the retirement plan for state police, that's due to that $215 million additional appropriation. What that also did was that brought the contribution rate down from 140% of pay to about 100% of pay. So significant. If we go to the next slide, in terms of investment returns, we've all seen investment markets and what's in the news. There's 5 insurance plans, 5 retirement plans, different assumptions, but think of about a -5 to -6% return. It varied. In terms of fund assets, compared to the expected return, there was about 2.7 billion less than expected. How that compared to last year in FY 2021 was just an extraordinary year. There was about 3.4 billion more than expected in FY 2021. So this offset, probably a good 80% of that, but there still is a net gain that's occurring with that. Comments on the valuation results on the retirement funds. When we measured the liability, we determined how much did they change compared to what we expected. There was an $880 million loss on the retirement side. That was primarily due to the 2 non-hazardous funds. In our val process, we identified that there's a group of retirees, current retirees, that are getting benefits from both HAS and non-HAS. and we needed to pick up the non-HAS portion of the benefit in terms of the liability and experience. So that was about 650 of that total amount, the rest being salary increases for individual active members being higher than expected. The other thing to note is there was across the board 8% increase in salary effective July 1, 2022 for state employees. So that'll be reflected in next year's data, as we start to see that experience flow through. So you could see additional liability losses due to salary increases next year as well. The big news on the insurance fund, there was a $2.6 billion gain on all insurance funds on a combined basis. And that's largely due to the premiums charged by Humana to KPPA to provide post-65 healthcare coverage. So giving a specific example, you think of the Medicare Advantage, the premium plan, which about 90% of post-65 retirees participate in. What Humana charged KPPA or charges 2022 for that coverage is about $227 a month. And in 2023, that charge will go to about $89 a month. So the cost of providing post-65 healthcare coverage to the system, dollars coming out of the trust, is much less, significantly less. Probably a factor of 65% or so. And that's the source of the gain. It's not just the gain in 1 year of the premiums, but it's the present value of those expected or anticipated gains. With that, I will pause for any questions this group may have.
I do have one question for you on this decrease in the Medicare costs. Is this a short-term situation? Are we looking that as time goes on, these costs are going to go back up? And do you all take that into account in your future evaluations, how you calculate the numbers?
That's been a common question those last few weeks of both boards and here. And so the short answer is we do build an assumption that those costs will go up in the future years. And we actually increased that assumption. It's called medical trend. And we actually increased it from 6% initially to 9%. And it trends down to something, an ultimate rate. However, we'll also note, just for completeness, Humana has locked in those a cost increase of no more than 5%, all else being equal, for the next 2 years. Now, some of that may change depending on what CMS may charge and that, so it may be a little more, a little less, but it's not just a one-time. It will not go from $89 back to $227 the next year. That's not anticipated, but it is anticipated will go back up.
Any other members have a question at this point? If don't see any, please proceed.
Thank you. Comments on payroll. Payroll is important for especially the KRS has and state police, because that's your source of revenue for collecting contributions. Think of it as, even though your contribution rate doesn't change, if your payroll goes up, the dollar amount of the funds you're getting will go up. And so we made particular interest on that. For the KRS non-HAS fund, that's no longer an applicable case because of House Bill 8 that was passed during the 2021 legislative session. Thank you. And it has worked very much as anticipated and has been instrumental in stabilizing the funding of the KRS non-HAS fund. And then for CRS, there's notable payroll increases. Some of that increase is on the individual member, city budgets, county budgets being favorable. Also, there was some increase in membership count, which will also increase covered payroll. Last slide. This slide we've provided many years, at least since 2017, since we've been providing services to KPPA. This is just a reminder to stakeholders. While there's been tremendous effort, and we thank the additional funding for the KRS non-HAS fund, there's still more to be done. That you have plan assets of $3 billion, and you can see the cash flow amounts below. And you're on the right trajectory, but it's just not done yet. There's continued effort remains. So, okay.
Okay. As Danny alluded to at the beginning, For the KERS and the state police plans, this valuation can really be just seen as informational. So the 2021 valuation, that was a valuation done last year. That set the budget for both this fiscal year, so fiscal year 2023, and also then following fiscal year, so fiscal year 2024. So the contribution rates and that we calculated in this year's valuation just kind of shows you where we're at today if we weren't on biannual funding. So you can see those contribution rates here. The contribution rates went down across the board. The main driver there is the insurance fund, so that's the decrease in the Medicare premiums that Danny alluded to. If we look at the K non-hazardous fund, we can see a decrease there. Again, a lot of that is due to the insurance fund on that amortization cost going from the $994 million to the $906 million. I will mention that we do have, we did in this calculation of our contribution rate, we did take into account one of the $250 million appropriations. We do have another one of those coming into fiscal year 2024. So when we come back and we do this valuation again next year, we are expecting an additional $20 million reduction in that amortization cost for the fiscal year 2024, $240 million appropriations. So that's just that, we'll see that in next year's valuation. But this year we did take into account one of those. So we can see in the K hazardous, again, a lot of that is driven by the insurance fund and state police as well. If we look at it in terms of dollar amounts, again, in terms of dollar amounts, the required contributions would have gone down as well if we didn't have the biannual funding. I will say one thing I will note on the state police, even though that pension contribution rate did stay pretty level, the contribution rate as a dollar amount did go up, and that is because we saw salary go up for the state police fund. It's a little bit of a different story on the CERS funds because they do change their contribution rates each year. So for this year's valuation, the 2022 valuation, that is going to set the contribution rates for fiscal year 2024. So again, a little bit of the same story. We saw big decreases in your insurance fund contribution rates, which is the main driver in the reduction in the contribution rates that we're seeing this year. If we look at it in terms of dollar amounts, a reduction in terms of dollar amounts, about $50 million for the non-hazardous fund, $17 million for the hazardous fund. But you can see on the pension fund, those dollar amounts are actually going up. And again, similar to the state police fund, that is because of the increases in the payroll. So the contribution rates went down for the pension fund, but because payroll went up, we're going to collect more money in terms of dollars. Looking at the unfunded actuarial accrued liability, for the KERS and the state police plans, the unfunded liability went down across the board for both the pension funds and the insurance funds. So that's great news. That's what we want to see. We want to see that unfunded liability being systematically paid off year over year. On the CERS funds, on the pension funds, that unfunded liability did go up a bit. That was driven by the higher than expected liability. But on the insurance funds, again, significant decreases in our unfunded liability due to those Medicare premiums. And I won't go through every number on these slides. This is really just for your reference. This is all of the numbers from our funding results for the KERS fund. But one thing I do want to point out is those numbers right down there at the bottom is the funded ratios, as Mr. Eager alluded to. The funded ratios for all of our funds, pension, insurance, all 10 of those funds across the board went up. And you'll see, especially on the insurance fund, you'll see those are actually above 100% for the majority of our insurance funds this year. So that's pretty significant, and it's significant to see those funded ratios going up across the board. Again, a trend that we really want to see. And a lot of that is really attributed to the funding that we're seeing going into these funds, the full funding that we're seeing.
I would say, by the way, if there's one page you want to take out of this evaluation and put it in your back pocket, this is the page.
Mm-hmm. So we have these for all the funds. State police, again, the insurance fund over 100% funded on an actuarial basis now. But again, that funded ratio going up. I will notice you'll see on the pension fund a big spike in our funded ratio there, and that is due to the $215 million contribution that we got in fiscal year 2022. For CERS, again, those funded ratios going up with those insurance funds over 100% funded. So I will pause there again for any questions.
I've got a lot of questions, but I'll try and limit it. We, KPPA has seen a drastic decrease in their assumption rates, particularly on anticipated return. What are other states doing? Are other states coming toward where KPPA is, or are they staying pat, or are they actually increasing their assumed rates of returns?
On a statewide basis, it's been a march downward, and what we're going to do is we'll follow up with to Mr. Eager a slide from the National Association of State Retirement Systems that show how that's trended down. Now you've marched when you take it in 2017 when you made the change to, or when KPPA made change to 5.25, that was a much bigger jump. So that's the biggest jump of any statewide system in the country, but it's been a march down. I think the average to date, or the median investment return, has been, it's either at 7 or just a tad below 7%, 7% right now. I've yet in the last 10 years to see a system increase their investment return assumption. However, that said, I think in 2022 you might see that. And the reason is where's your starting point on your economics. If you look last year, 10-year Treasury bonds at 1.8, PE ratios on equities were high. And now you can, on 10-year Treasuries, 30-year Treasuries, you can lock in 4.2, 4.3, depending on what day it is. That's a huge, that's a huge increase. You can lock in when you buy a bond, you're guaranteed your return on that, especially a Treasury, because there's no default risk. And so to get that incremental increase after that hurdle to an investment return is much easier. So I think at the very least, you're probably going to see somewhat of a pause or a slow trend in lowering the rate, maybe even a few increase.
At this point, would you make a recommendation to increase the assumed rate of return for any of the KPPA systems based on the current information?
The information today, no, but that may change 6 months from now.
Okay. Any other member have a question for at this point? Anything else you want to add while you're here?
It was a pleasure to be here today.
Oh, I'm sorry.
So a lot of new.
You're not done yet. Co-Chair Higdon has a question.
Ask you the same thing that I asked Bo a minute ago about ESG and the voting, the proxy voting. What are your policies in place? There's a lot of talk about that, and just want to make sure that you're on top of it.
Yeah. With regard to ESG, we have a pretty simple statement that those factors, the E, S, and the G, to the extent they affect a company's outlook and profitability, we would factor that into the evaluation. But beyond that, we don't restrict, eliminate any investments on an ESG basis. With regard to proxies, we're in the process of going out to all of our managers. It's going to take some time, asking them to adopt our proxy policy and write it into the investment management agreement. I don't know that we'll get uniform compliance, and we have to look on a case-by-case basis where we don't. But by and large, the managers use ISI to vote the proxies, and their ISI is very similar to our own proxy policy. So I'm not concerned about it at the moment, but we do want to comply.
Thank you.
Well, I don't see any other questions right now, so it's good to have you here in Kentucky, and thank you for your presentation. I'm confident we will be having future conversations. Next on our agenda and last is a presentation from the Teachers Retirement System with an update on their evaluation. So, Bo, if you'll come to the table and introduce yourself for the record, and please proceed.
Good afternoon. Bo Barnes. I serve as Deputy Executive Secretary and as General Counsel for the Teachers Retirement System. I've been asked today to give a similar presentation on the recent valuations. And with that, I would like to say up front, these final evaluations were just presented to our Government Audit Committee yesterday afternoon, and staff have really not had much time to go over these valuations. And as a normal part of the process with these valuations, we always have questions for our actuaries. We always want to get more background about the calculations. And in fact, I have emailed the actuary already a lot of questions that I have about the values, just so I understand it better. That said, there are some questions you may have today that I am unable to answer, but I will do my best today. Thank you. Okay, first, key happenings since the beginning of this year. Well, the investment returns, of course, are always a key driver in what your funded status is going to be. And we've already heard, we all know that 2022 fiscal year was a down year in the market in comparison with the previous year, which was a 30% return. This year, we had a negative 10.68% gross, negative 10.89% net for the annuity trust, which pays the pensions. The insurance trust had a negative 4.3% gross, negative 9.67% net return. And these are the market value numbers, okay? So what the actuary is going to look at, and we've heard about that, the actuaries do what they call actuarial smoothing. So instead of using just 1 year's return, they use an average of 5 years that smooths the returns. And we have a slide, I need to present that sometime, but it shows that 5-year smoothing, a line that shows that 5-year smoothing, the impact on assets versus the actual market. The actual market's like this. This year's down, last year was way up, but the 5-year smoothing, it follows the volatility of the market very well, and just right in line, right in the middle. So that's why we do it. It helps with budgeting. We have more consistent budgeting when we use a 5-year smoothing. So with the actuarial smoothing, we actually had, using 5 years, a 7.9% actuarial gain, which is above our assumed 7.1% assumed rate of return. Other things, another big thing that happened, and we're very appreciative of the General Assembly for the $479 million that was appropriated to pay off certain past benefit adjustments. That was received in late April. That was a very good time to receive that lump sum payment, and we've been able to put it to very, very good use when the market was down and buying low, which is what we always want to do. No assumption changes for the year. I will note we did have, of course, have a new tier take effect January 1st, TRS-4, a completely new tier. We only have about 3,100 members in that new tier so far, and they're mostly part-time, and we only have 6 months experience. So we don't really have anything to report on TRS-4 yet, but that will be coming in future years when that tier starts to build out, and it will very quickly start to gain more and more members. Okay, here's a summary of the valuations. The top boxes reflect the retirement annuity trust, and the bottom boxes reflect the health insurance trust. And we're comparing, on the left you'll see June 30th, 2021 with June 30th, 2022. So starting with assets, and this is the actuarial value of assets, not market value. The actuarial value of assets, June 30th, 21 was $22.6 billion. June 30th, 2022, $24.1 billion. Liabilities, June 39.6 billion. This is total liabilities. $39.6 billion in 21, increased slightly to $41 billion in 22. The unfunded ratio decreased very slightly from those 2 years, from $17 billion in 21 to $16.9 billion in 2022. And the funded ratio we see here improved from 57.2% to 58.8%, which is the highest it's been in many years. So good news there. The bottom row of boxes, health insurance trust, same presentation. We see assets grew from $2.1 billion in 2021 to $2.4 billion in 2022. Liabilities also increased slightly from 3.5 billion to 3.8 billion over those 2 years. The unfunded ratio stayed about the same, 1.4 billion, but the funded ratio did improve from 60% to 63.7%. Cash flow. So with that $479 million that we received in April, that gave us 140% of the actuarially determined employer contribution for the pension, okay, because of that payment. And that had a big impact on negative cash flow, as you might assume. So negative cash flow for 2022 as a percentage of assets was a 1.19%, okay, negative 1.19%, compared to, you can see the other years at the bottom of the slide, where it's around 3.5% and 3% range. Without that $479 million, negative cash flow for 2022 would have been pretty consistent with prior years. This is what our actuary does every single year. They look at gains and losses over what they projected would happen with certain assumptions and what actually happened. Again, they do this every year. And then they take these gains and losses and they amortize them over a 20-year period. Now, we've had about as many gains as losses since we've been doing this for 8-9 years now. We have slightly more losses than gains, but these are small. And because they are small and because we are dealing with them each year by amortizing them over a 20-year period, we are dealing with them so that they will not have a major impact, on the main funding goal and getting us to full funding here in just over 20 years. So you see here investment return. It was a gain here, again, because we're using the actuarial investment return of 7.9%, which again is more than our assumed rate of return of 7.1%. Salary increases is a loss here. What that means is individual salaries of teachers overall were greater than anticipated for this year. So when teachers have higher salaries, that means that they're used for retirement calculation purposes, higher salaries, higher retirement allowances. That's why when the salaries are higher, that means we're paying out more in benefits because the retirement allowances are going to benefit, and that's why we have a negative number here. These others are not quite as important. Turnover and retirement. We had a few more retirements and fewer turnovers than we expected. Mortality, we moved to a very conservative, more conservative mortality table that's teacher specific. And it also has a generational approach that takes the viewpoint that younger active members are going to live longer than older active members, those in their 20s versus those in their 50s or 60s. So positive experience there from an actuarial standpoint. New entrants, we had more new entrants coming in than anticipated. They carry a little bit of liability. There's some liability there because they may have reciprocity service with the KPPA. There's liability there because they could get hit by, they have an injury, a duty-related injury the next day and get disability, or death, life insurance and death benefits. So there's some liability for new entrants that the actuary measures. Others, contributions coming in. This is a whole lot of things that goes into this bucket, but positive $243.9 million. And of course, no assumption changes, so no need to make changes there. This is the 2024-2026 budget request. And we were asked to compare previous years with current and projected. So you'll see in the top line, actual in 2022, $682 million. 23 and 24, and this is just for pension, is $690 million respectively for each year, just for the pension. And this is a preliminary number for fiscal year 25 based on the valuation that they just completed for 2022. And you see an $805.7 million preliminary for fiscal year 2025. Fiscal year 2026 is not available yet because there's a 3-year lag. Fiscal year 26 will be available this time next year when the evaluation for fiscal year 2023 is completed. Health insurance, we're seeing pretty consistent, 71 million in 2023, 77 million in 2024, and projected preliminary 77 million in 2025. And we don't have 2026 yet. We're going to be, when we get closer to that year, Health insurance can change a lot for a lot of reasons. You know, what's the KEHP premium going to be? You know, what's going to happen with medical inflation? What's going to happen with some of these federal subsidies and programs that really pay the bulk of the cost for our 65 and over health insurance? Those can change a lot. So we kind of wait and get a little bit closer to the point of the budget request when we have better numbers to present to the General Assembly. And then, of course, for 2022, you'll see that $479 million that was appropriated to pay off some previously awarded benefits, which for that year, 140% funded. And again, very appreciative of this funding. It came at a very good time and is being applied very well. So with that, that is my presentation. The things I was asked to cover today. Be happy to take any questions about my presentation or anything else.
Thank you, Bo. Co-Chair Higdon has a question.
I have a couple of them, Mr. Chairman, if you don't mind. Bo, thank you for that report. I'm on, I guess on the summary page, talks about the assets. From June 30, 2022, it showed them 24.1 billion.
Yes, sir.
And that looks like that's up 1.5 billion from the year before.
Yes, sir.
And then we'll go over to liabilities, 39.6 last year and 41 billion this year, and that's up 1.4. So it's kind of a wash there. What's your assets were up, but so were your liabilities.
Yeah, so that's, looking at that previous page, for example, the gains and loss slide, we have a slightly increase in liabilities, very slightly greater increase in assets. So that's why you saw just a very marginal decrease in the unfunded liability from 17 to 16.9 billion. But overall, you did see an improvement in the ratio because of the increase in assets.
Okay, and I'm looking at the. Of course, we always talk about negative cash flow, and I noticed last year was 1.19, and I assume that the money, the green box dollars, made that much lower than. Because it's been going up a little bit. Looked like almost every year. Well, 3.63 in 18, and 3.68 in 20, 3.85 in 21. What would the percentage have been without the green box dollars?
The actual tells it would be very close to the 3.85%
Okay.
in the previous year.
What dollar amount? What is?
Don't have that off the top of my head. I apologize. If I had a few minutes, I could probably calculate it in my head, but it's I can get that for you.
Okay. Then over on the next page, with the smoothing, looks like it by doing the 5-year smoothing, gains were 178 million. Am I reading that right? Investment return.
That's correct.
And what would that have been? I think it was about $1 billion last year when it was smooth. I guess that's the difference in the losses that we had. How many years out of that 5 years that you're smoothing did we have losses?
Oh, let's see. We had a loss this year, of course. Last year was a gain. The year before that was a loss. Then we had a gain. And the year before that, the 5th year out, seems like that might have been a loss too. I think that was a loss.
Okay. And one other question, Mr. Chairman. I noticed on the 24-26 budget request, we go from this past year, 23 and 24 budget request of $690 million, and it jumps up to $805 million, and for 25, and you don't have 26 on there yet. That's it looks like it's been run along fairly consistently, and then all of a sudden we take a pretty good jump. Is there What's the main reason on that?
That's one of the questions that I have pending with our actuary right now. I have a list of questions, and this is as normal when we get these valuations. Staff always have a lot of questions. We want to make sure we understand, so we know and that we can explain, to other stakeholders and the public, what these numbers mean and fully understand them.
Of course, I can't help but remember, we put $500 million in back in 2016, and $500 million in each year, and that seemed like a whole lot then, but it was a deal compared to $805 million.
Yes, sir. I'll get some answers for you on that.
Okay. Thank you, Mr. Chairman.
Chairman Miller has a question.
Thank you. As it turns out, I'm going to be following right along on Chairman Higdon's line of thinking, and that is, I would say part of that jump is going to be the drop in your assumed rate of return. Would you not agree with that?
It is partially that, but that
because there's a delayed impact when you do that, correct?
We recognize the full drop in the rate of return, and the secondary thing was the change in mortality tables. Those were both very big. The change in mortality tables was a one-time thing going to teacher-specific mortality table. Those both had a big impact, and we recognize those immediately for purposes of the valuation, the funded status that I just reported to you, unfunded liability, all of that. But as far as budgetary item, because we had that huge gain in 2021, the 30% return, the over $5 billion in additional, increase in value of the pension, our actuary recommended that we could harvest those gains sort of by phasing in the reduced assumptions on future returns and on mortality at 1.7% per year over 5 years. So that's linear, as its impact on the funding that we're asking for in the budget. It's at 1.7% per year growth. It is somewhat incremental. That will be part of this, though, because we're adding another 1.7. But since it's not an all at once, not recognizing all of that at once, I don't think it explains everything.
Okay.
But good question.
And lastly, on the, could you, do you know off the top of your head, or do you have it with you, what's the trend line over the last 4 or 5 years in terms of membership, the total members of TRS? Is it declining continually?
It's been pretty steadfast. COVID, those 2 years changed everything, and they don't provide good data because that was an outlier. But slightly increasing, but pretty steady around 75,000. We're not seeing a decline in membership.
But in terms of actives, is it also steady?
Yeah, in terms of active, yes. About 75,000 full-time and part-time members. It's kind of held around to that number for a while now.
All right. Thank you, Bo.
Yes, sir.
Co-Chair Higdon had an additional question.
Thank you, Mr. Chairman. And Bo, I just remembered a conversation we had about this time last year that when we changed those assumptions, our great year last year and the market was going, it would offset those gains or those assumption changes. But how time does change things.
Yes, we will still have, because 2021 was such an exceptional year, and we did have such gains for that year. We still have gains from that year despite the negative 10% year we just had. So that's and with those gains and with the full funding we're getting now, and with the $479 million, we're in a constant process of selling high and buying low. So when the market was really hot over the last part of 2021, well, before that even, and to early 2022, before the market declines, investment staff, we sold $2.5 billion worth of investments. We sold, for example, stocks that were running really hot, really high. And we took that $2.5 billion, put a lot of it in cash, bonds, those sort of things. And when the market declined, we were able to put that back to work in every asset class when they were selling lower and take advantage of the down market.
Thank you, Mr. Chairman. Bo, I appreciate the 24-26 budget request. As I recall, Chairman McDaniel inquired about that last month. The $805 million, now that does not include the statutory contribution. This is just
Yes.
the additional contributions made above the statutory contribution, which is, I'm saying, what's that, in the 525, 550 million range, probably?
It's close to 500 million. Yeah. So that's this is the TRS general request out of the general fund.
Okay.
And there's additionally KDE makes a request for the SEEK formula for the fixed statutory that you're talking about.
Do your actuaries have any projections or on what these contribution levels will have to be in the next 5 to 10 years?
They haven't provided that yet, but that is something that maybe they could provide. I mean, because
I think for us as a General Assembly, it's very important for us to know what trajectory that we're on.
We are looking at payroll growth of 2.75% a year is what the assumption is. So we would expect the growth and budget requests from the SEEK formula to grow at that rate.
On your gain-loss analysis, on the salary increases causing an actuarial loss of 285.9, did I understand you, is that due to increases in salary?
That's correct.
So those are due to increases in salary. On your other, 243.9 million is a lot there. Could you go into a little more detail about what's included in that other?
That is a lot contributions coming in, and I want to make sure I understand their breakdown here and what they included for this year in this slide.
Yeah, if you could get that information for us, it would be greatly appreciated. And I know Senator Higdon and the other two presentations talked about how is TRS approaching this issue of ESG investing and proxy voting? Could you just give us an update on where you all are with that situation right now?
Yes, I'd be glad to. Again, in fact, we have a trustee workshop coming up, and every year we have when we have this trustee workshop, I give a presentation on ethics and fiduciary responsibility. And then what we start out with every year is that every member of our board and staff are fiduciaries, and that's not just a noun. It is a word that has real legal consequences. It's a word that's been subject of court cases where there have been consequences for individuals who are not fiduciaries, acting as fiduciaries. And being a fiduciary means you have one goal only. You are serving in the best interest of the people you are acting as fiduciary for. So, and for investing, what that means is that as fiduciaries, board members, staff, we are investing for the best value for our members within acceptable levels of risk. So it's both. Best value, acceptable levels of risk. TRS is not an ESG investor. We've been asked throughout the years, again, I've been there since '99, periodically get requested to invest in a certain way for certain causes, whether it's the Sudan, firearms, tobacco. That happens often. And we tell them that, we're fiduciaries, we only invest for value. And that's in our policy. And it's also with our proxy voting, we use institutional shareholder services. And part of our agreement with them, that's the same way they vote. We vote our proxies, but they understand. We expect recommendations and evaluations from them on proxy votes to be consistent with our role as fiduciaries, and that is enhancing and protecting shareholder value. And that's what we do. I will say that most of these proxy votes that we get, that we review, our staff review, and then send back to ISS to vote, we tell them, most of the recommendations that we see, I think probably all of them have been consistent with our fiduciary responsibility. But most of them are more run-of-the-mill. It could, like appointing new trustees to the board. That's a proxy vote. Selecting an auditor to audit the company, that's a proxy vote. And mergers and acquisitions, that's a proxy vote. So that's largely what you see. But certainly we expect, and every vote that we cast, we want to be for shareholder value.
Any other member have a question for Bo at this time? Well, I appreciate your presentation. Before we adjourn, I want to remind the members of PBOB and also any member of the General Assembly who is listening, and Leader Thayer, I appreciate your comments last month that we were asking that if you have legislation that's dealing with pensions or retirement system, to present that to PPOB during the months of December and January for us to go through that, review that legislation, and vet that with you. I anticipate that we will have a couple of pieces of legislation in December. So if anybody else has something you want to present, please contact myself, Co-Chair Higdon, or a member of staff. Yes, Leader Thayer.
Thank you, Mr. Chairman, for that reminder to anyone who's thinking about running legislation. To be clear, in the Senate, any pension-related legislation will go through the state and local government committee, but we'd like to have it at the request of the co-chairs to go through PPOB first to get properly vetted before we move forward during a regular session. Thank you, sir.
Absolutely. If there's no further business, we will meet again in December. And thank you for your attendance. The meeting is adjourned.